Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Our last and fourth rule. You'll notice that I've got some little bands up here. And let me erase that line I just drew in there. And I'll just draw a box around it. Okay? Those wave 4 bands. What those wave 4 bands are called is the time and price channels. Elliott wave 4 should not retrace past the red band. If it does, and the red band as you see is right, change my tool to a red line. This is our red channel. The market should not retrace past that red channel. If it does, kind of like a low PTI, it tells you that the chance of this market making new lows is diminished to a point of we should not try to sell it. The market will either rally and go higher or it'll go sideways. The market pattern becomes unpredictable. Now there's also a few other bands. We've got a blue and also a green. If the market stays below a blue band, statistical odds say you've got a better than 80% chance of a new wave 5 low. Now this market, again, we're trying to sell off, or for the option strategy side, you'd be looking at puts. We're anticipating this market moving lower. If it stays below the blue channel, the pattern has an 80% chance or higher of staying and making that wave 5 low. That doesn't mean you'll be 80% right in the trade. That doesn't mean it's 80% accurate from the money side. Volatility could change. Your option could expire worthless, even though the market makes new lows. The market could fluctuate, stop you out of your trade. Maybe you don't decide to get back into it and then make a new low. Just because the pattern has an 80% chance of making new lows doesn't mean you'll make money 80% of the time. And I know that's kind of strange to talk about that, but I've seen this over the course of my 12 years trading. I'll short the market because the market looks like it's going to go down. It'll go down for a day or two, reverse and stop me out, and then I lose confidence in the pattern. 3 days later, it goes back down, starts selling off. I don't get back into it, and it makes a new low. The pattern worked fine. I didn't have the trade in there to get into it. That's what happens in markets. It happens every day. So don't look at a band like an 80% band and say, well, I've got an 80% chance of making money. It doesn't work that way, unfortunately. If the market exceeds the green band, now the green band here is actually right on line with the red band, so they're kind of matching up together. If it takes out the blue and holds the green, you've got about a 60% chance at a new wave 5 low in this case. Usually if it takes out the red band, you've got less than a 50% chance at making new lows. It's not typically a trade that you'd want to take. So to kind of review the rules for the type 1 trade, and what we're looking for in a market like this is the Swiss franc back in September. We're looking for, let me erase some of these lines I drew in. We're looking for this market to make new lows. Option side, you're going to be looking at a put. And like I said, now there's a couple things you can do options-wise. I don't want to get into the gory details of different strategies with spreads, but from a simple perspective, you think the market's going down, you get a put. The market here should decrease to a wave 5 low. Now, the second part of this, you've got the first 4 rules. Elliott wave 4 is present, profit-taking index 36 or higher, oscillator to 0, holding the wave 4 channels. Now again, the wave 4 channels, it's up to you how you manage those. At the end of the day, make sure it's holding the red channel. If it isn't, then don't take the trade. So right here on the Swiss franc, we've got a good potential shorting opportunity, a good opportunity for a put. Next step is, where is it going to go? We know it's going to go down, but when and where is it going going to go. There's a special tool in our software that's very helpful for this. It's called the MOB objective, M-O-B. The M-O-B is a Gann and Fibonacci tool. Remember how I told you everything revolved around Elliott, Gann, and Fib? Well, the Elliott is the pattern. Wave 4, oscillator, that's all Elliott. Gann and Fib are predicting this market to make a new low on October 16th at 85.30, roughly 85 cents. The market was at 91 cents that day. It's predicting about a 6-cent move. Pretty nice move on the Swiss franc on a daily chart. Now, how I apply that MOB, if I want to see what my prediction for the wave 5 will be, I apply my MOB from the previous wave 3. I click on the wave 3, and it predicts where my wave 5 will occur. So I'm not in the trade yet. I haven't made the decision to go out and find my option. All I've done is I've predicted that the Swiss franc should sell off to about 85 cents on or around October 16th. Now, understand timing projections in a market. These aren't going to be right on the money. It's not going to be, all right, October 16th is where I do it. It's going to be in and around that time. The market on that day was September 22nd, and we are giving you roughly an October 16th window for where that market will be at 85 cents. So you've done the examination. You've got the trade, maybe from the dashboard, or maybe you were just watching the Swiss that day. Now you've examined it. Wave 4, PTI, oscillator, wave 4 channels. You've set your profit target along with the time projection. Now it's time for step number 3. We trigger. Where do we trigger the trade? We would use a standard entry technique such as a regression trend channel. As long as we break that regression trend channel, which we did right here around September 27th or 28th, right where we broke that lower band, and I'll kind of highlight that a little bit more. It doesn't have to close below there. All we need to do, oops, I used my highlighter as opposed to my line. I'm new to WebEx a little bit. We use something a little different in eSignal Learning, but we used WebEx back in the day. As long as it breaks that red channel, we can go ahead and place our trade. Go into your broker software, look for the strike prices around 85 cents at October 16th. If it meets your reward risk criteria, now what I mean by reward risk criteria, markets should typically have a 2-to-1 reward risk ratio, and you should not be risking more than 1% of your account. Yes, I know you're leveraged on options. Yes, I know that they're safer than buying or selling in their outright forex contract in some cases because you have limited risk. But you should not risk more than 1% of your account on any given trade. That's for money management's sake. You don't want to put 20, 30, 40% of your account into one position, because as a trader, and I can't stress this enough, even the best traders in the world are still going to be wrong 20 to 40% of the time on their positions. You're going to be wrong occasionally. Only risk a very small portion of your account. If you take 3 or 4 losing trades in a row and you're risking 20 to 30% of your account will be down 70, 80%. You can't do that and make money. If you're only risking a small portion of your account and you lose 3 or 4 trades in a row, you'll only have a 3 or 4% drawdown. Money management is the most important aspect of trading. Only risk a small portion of your account. There is a risk of loss in trading. And like I said, even the best traders in the world are wrong 20 to 40% of the time. Manage your money properly, and the wins that you have will take care of your losses.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.